Good evening and welcome to AEI and today's author book signing event. We have the pleasure of hearing from author Paul Sheard and when he speaks about his new book, The Power of Money, How Governments and Banks Create Money and Help Us All Prosper. In addition to hearing from Paul Sheard, we have tonight Arnold Kling, who's an independent scholar and a prolific author who will provide his perspective on Paul's new book. I am Paul Kupiec, a senior fellow here at AEI and the host and moderator of this evening's event. After hearing from Paul and Arnold, Arnold and I will discuss selected topics in his new book and take questions from the audience. We will wrap up discussion in time for Paul to sign copies of his book. AEI has a limited number of copies available free of charge, and you're welcome to them. And I don't know if we have a total enough for everybody, but close. Dr. Paul Sheard has an impressive resume. Most recently, he was a senior research fellow at Harvard Kennedy School. He's a former vice chairman of S&P Global and was chief economist and head of economic research at Lehman Brothers, among other past positions. Paul earned his PhD at Monash University in Australia. Prior to this event, I'd only met Paul virtually through email exchanges regarding his economic commentaries, of which he has many. When he told me last year he was writing a book, I offered to hold a book event at AEI for him. Based on his commentaries, I anticipate that Paul and I will likely have different views on some economic issues, but I thought hosting a book event, reading Paul's book and hosting a book event for Paul would allow an AEI audience and myself an opportunity to better understand his perspective on the economic policy issues of the day. Please join me in welcoming Dr. Paul Sheard. Thank you.
Well, thank you very much, Paul. It's a really great pleasure and an honor to be at this august institution, the American Enterprise Institute, to have the opportunity to launch my book. This is really the first book event that I've had, so very much looking forward to it indeed. So the book that you have, some of you have in front of you, and is on display there, is a book about money. Not, I hasten to add, about how to make money, but what money is and how it works, which is a little bit more complicated story than you might think. So let me start with some very tangible money, which is this $20 bill, which has, as you know, Andrew Jackson's face on it. There's quite a little story or interesting inside joke about this, but I won't take a detour into that right now, but we can come back to that later if you like. So this bit of paper money might seem like quite a relic these days, with everybody using all sorts of electronic forms of money. But funnily enough, it still makes up about 9% of what economists typically, although somewhat narrowly, referred to as money or measure as money, which is the M2 measure. But what I'm interested in is, where did this money come from? In the sense of, how did it get into circulation in the first place? Now, I might have got it from a shopkeeper who gave me some change if I was passing notes and getting change, or perhaps my wife, who's sitting here in the audience, gave it to me. But no matter how many times it kind of changed hands and moved around the economy, it had to start life somewhere. And of course, if you think about it, it started life in a bank deposit, as a deposit in a bank account. Now we're talking real money, because there's something like $17 trillion of bank deposits in commercial banks in the United States. So now we can shift the question. It came out of a bank account, came out of a deposit account. So we can shift the question one level and ask, well, where did the money that's sitting in bank accounts come from? Now, you might have got some of the money in your bank account from a paycheck, or maybe you sold some stocks. That means you got the money from somebody else's bank account. But if we step back and say, well, where did money that's sitting in bank accounts, that $17 trillion and increasing, come from in the first place? What was its genesis? Now, I point out in the book that mainly there are three key ways in which money comes into existence. And bear in mind that that money, as I think the opening lines in my book say, make the world go around. The monetary economy is very important in supporting the real economy that produces the goods and services that we consume. So the first way in which money comes into existence, into those bank accounts, is perhaps the obvious one, which is that banks create deposits or money when they lend. Now, this surprises many people, and that's probably the main way that money comes into existence in this modern economy. And that surprises many people because we're used to talking about, in terms of banks taking in deposits and then lending out those deposits, as if banks needed deposits first in order to make loans. This actually theory has a name, which is the loanable funds theory. But actually, bank lending doesn't work that way. Banks create deposits when they lend, not the other way around. Now, of course, people borrow money for a reason, that is to use the money. So it is the case at the level of the individual bank. Once they've made a loan, usually part of, and sometimes even all of that deposit money will leave their bank and move around the banking system. But for the banking system as a whole, other than some leakage into banknotes, those $20 bills that I was flourishing before, loans are in a sense self-funding. Now, the second way that money comes into existence is when governments spend. Governments create money. Federal governments I'm talking about here, the sovereign governments, create money when they spend, and although we don't usually think of it this way, they destroy money when they tax. This surprises people too. We're used to thinking and talking about in terms of governments needing to raise taxes in order to get the money to spend, or needing to borrow by issuing bonds to finance a budget deficit. But this is an artifact of the way that we, society, have arranged things. Because the government can create money at will by writing checks on itself, you or I can't do that, but the government can, we, society, have collectively decided to put shackles on our ability to do so. Now, when we have this kind of discussion, there's an important distinction to make between how things operate at an underlying fundamental level and how they operate in practice, for example, in this town, because of the institutional frameworks that have been developed over time and which constrain things. Failure to appreciate this distinction can often confuse matters and lead people to talk past one another. Hopefully, part of what we'll achieve today is the ability not to do that. At a fundamental level, governments create money when they run a budget deficit. But at an institutional level, as things operate in the real world, if you like, it appears that they do have to borrow money in order to do so. At an institutional level, it looks like governments have to repay the money they've borrowed, hence the widespread concern about all of this debt piling up, representing a mortgaging of the future of our grandchildren. But at a fundamental level, and this is a little bit surprising, but I'll try to make the case, the government never has to repay its debt as such, in the way that you would have to repay a loan, for example, if you took it out. So look at this $20 bill again. This is a liability, actually says at the top, Federal Reserve note. This is a liability of the Federal Reserve. And the Federal Reserve is part of the federal government. And as if to prove that point, the bill is signed by the Secretary of the Treasury and the US Treasurer. They're two separate people and two separate positions in the federal government. It's not signed by the chairman of the Federal Reserve. But the Federal Reserve, or the government of which it's a part, never actually has to repay this debt, this liability that sits on the Fed's balance sheet. This is the nature of fiat money, essentially. There's no commodity that lies behind this. It's just the full faith of the US government that gives this the value. It just is, so to speak. Now, in a fundamental sense, I would argue that the government no more has to repay its $19 trillion of debt that is in the hands of the public at the moment than it has to repay this $20 bill. I said $19 trillion, you probably hear this $31, $32, $33 trillion figure. but that's all federal debt, including debt held by other parts of the government and also held by the Federal Reserve. I argue that government debt is best viewed, although economists don't normally do this, I argue that government debt is best viewed as another form of money in the sense that it is purchasing power created by the government. And if there's too much of it in existence, the government may have to withdraw some of it by raising taxes, that is, by tightening fiscal policy. But then the aim is not to raise money, but to destroy it, as counterintuitive as that might sound. The government doesn't need the money. The government needs to withdraw the money from circulation, in which case it essentially disappears because it's the government's liability. The electronic version or the digital version of a Federal Reserve note, like that $20 bill, are the balances that banks, commercial banks, hold at the Federal Reserve, called, appropriately enough, reserves. That's the reserve in Federal Reserve. They play a critical role in the way that the Fed and other central banks operate and implement monetary policy. And there's quite a lot of detail about that in the book. The early chapters in particular, I won't go into that now. But like banknotes, reserves, which are a liability of the Fed, that is ultimately a liability of the federal government, never have to be repaid. There is no due-by date attached to reserves. Now, currently, there are about $3.3 trillion of reserves sitting on the Fed's balance sheet as a liability and on the banking system's balance sheet, of course, as an asset. In principle, again, in principle, this is not going to happen very likely anytime soon, but in principle, the Fed could refinance the entire federal debt into those central bank reserves. And that's a stark way of seeing that government debt doesn't have to be repaid per se. The government is not like a household or your children with a credit card, which is the way that some politicians like to portray it. Can't blame them for doing that, but that's not really the appropriate analogy. Now, many people, and it's very easy to do this, misconstrue the basic insight I'm trying to impart here. It doesn't mean that government debt doesn't matter, that debt doesn't matter, or that the government can spend whatever it likes, how much of it likes, on whatever it likes. Just because something is possible doesn't mean that we should do it. Government debt is money or purchasing power in a different form, and too much of it will lead to inflation, as Milton Friedman famously pointed out. And we've seen that movie playing out recently with the burst in inflation. So that's a big reason why we might want to worry about the size of the budget deficit and the size of the pile of debt that is piling up, because it's inflation. It's potentially, under certain circumstances, inflationary. Now, there's a wide spectrum of views in the political realm, in the policy realm, in the public realm, about how big a role the government should play in the economy and what kind of role it should play. That's something that is contested fiercely in the political arena. So that's another reason for some people to worry about big chronic budget deficits and a lot of government debt piling up. If you don't like big government, you probably won't like big deficits and you won't like a growing mountain of debt. But that has nothing to do, directly at least, with government debt somehow representing this burden on our grandchildren and somehow mortgaging their future. I would contend that our grandchildren will, and my grandchildren are already alive, will inherit the greatest stock of productive assets, the infrastructure and the productive assets that produce the $26 trillion, I think it is now, of GDP, $26.5 trillion of GDP that is produced in the US at the moment, and that keeps going up, of course. And they will also inherit the greatest stock of scientific and technological know-how of any generation to date. Just think of AI to get that point. If we don't destroy the planet and blow ourselves up in the interim, of course, but that takes us away from pure monetary matters into a different kind of discussion. So these two main ways in which money is created and gets into circulation in the economy and supports economic activity, bank credit creation and government deficit spending, they map roughly into the two main macroeconomic policy tools that we have, monetary policy and fiscal policy, respectively. Now, economists in recent decades have tended to favor monetary policy over fiscal policy as a means of keeping the economy at full employment and keeping the inflation rate low and stable. Unless there is a big negative shock to the economy, such as we saw in 2008, 2009, and then more recently with the COVID pandemic, in which case the big fiscal guns are rolled out. Monetary policy is relatively simple. If inflationary pressures are too strong, the central bank just needs to tighten monetary policy, typically by raising the interest rate, its policy rate, short-term interest rate. And if disinflationary forces are predominant, which has been the situation in Japan for several decades until recently, and also for a decade or so in the US and other parts of the developed world, if those disinflationary forces are making it difficult for the central bank to get the inflation rate up to its target rate, typically 2%, then it eases monetary policy, just cuts interest rates. By making the central bank independent and giving it a clear mandate, the government can credibly commit not to abuse or exploit its access to the printing press, as it's called. Monetary policy works as a three-step process. The first step is the central bank turning its monetary policy knobs. Sits over there in the Eccles building, in the boardroom, and decides on the monetary policy parameters. The second stage is very important. That is financial and credit conditions tightening or loosening accordingly, depending on what the Fed is doing, as the case may be. And then the third stage is what matters for us, in a sense, is the real economy responding to either the restraint or the stimulus that is coming through those changes in financial conditions. So, three-step process. But what happens if the central bank, needing to stimulate economic activity and having the main job for doing that, cuts its interest rate to zero and still needs to impart monetary easing to the economy? It hits the zero lower bound, or the effective lower bound, as it's called. Enter quantitative easing, or QE. And there's a chapter in the book, chapter 4, which is devoted to that topic. Now, QE happens when the central bank buys bucket loads of assets, typically government bonds, treasuries, or treasury bonds or bills in this country, financed by creating reserves, those deposits that banks have at the commercial banks have at the Fed we talked about before. So the central bank, the Fed, can just create those reserves and buy typically government debt securities. Also in this country, typically a portion of mortgage-backed securities. Now, this can get a little bit complicated, but depending on who the central bank buys the assets from, bank deposits may be created too. That will be the case if the seller of the asset doesn't have an account with the Fed directly. Roughly speaking, if it is not a bank. If it's a hedge fund, mutual fund, an individual, corporation, then it will get a bank deposit in return for selling its government debt securities to the Fed. Now that sounds a lot like money printing, and in a narrow technical sense it is, and that's the third way that bank deposits are created. Bank credit creation, government deficit financing, and then quantitative easing by the central bank. But the important thing to realize about quantitative easing, in my view, and I've studied this for now more than 2 decades because I was sort of at the coalface in Japan in 2001 when the Bank of Japan launched its quantitative easing. Had to figure out what the heck was going on. Quantitative easing doesn't really create any new money or purchasing power in net terms. It just changes its form. We're used to hearing about the Fed and other central banks pumping liquidity into the banking system and into the economy. And charts showing this explosion of central bank balance sheets since the global financial crisis, and even more so since the pandemic, have become staple fare in financial market reports and commentaries. Probably everybody in this room has seen these startling charts. But what is not usually said is that for every dollar of reserves or liquidity or money that the Fed pumps in, it's sucking out a dollar of treasuries and, again, the Fed's case could be mortgage-backed securities, which are a government-guaranteed asset. So QE is just changing the composition of the aggregate portfolio held, the aggregate financial portfolio held by the private sector. It doesn't inject any new net purchasing power into the economy. It's the indirect effect of so-called portfolio rebalancing, a rather mysterious process that I explain in the book. That's the channel via which QE is supposed to work, and I think to a certain extent does work. When the central bank buys government bonds, not some other asset, for example, the Bank of Japan does buy some risk assets like equities and corporate bonds and some other private sector risk assets. But when the central bank buys government debt securities, QE is really just a debt refinancing operation of the consolidated government being the overall government, including the central bank, now looking at it as one unit, the federal government. It's a debt refinancing operation of the consolidated government, but it has a twist because the debt refinancing, which is the retirement of debts of treasuries and their refinancing into central bank money, reserves, that debt refinancing operation is conducted not by the Treasury, but by the Fed. That's why people sometimes look at QE and say, this is kind of like a quasi-fiscal operation, and I think that's quite true. The profile of the consolidated government debt changes, but not the total amount. So it's no wonder when you think about it that QE is generally regarded as being a bit of a damp squib when it comes to its monetary easing effect. That massive explosion in central bank balance sheets didn't lead to inflation when it happened. We got inflation much later on in the way that some people thought it might do at the time it was being done. Now, recalling that reserves are like banknotes, that $3.3 trillion of it now, QE shows that the government, in principle, in theory, could convert all of its outstanding bonds into a form that never has to be repaid. Treasuries look like they have to be repaid, refinance them into central bank reserves, which are sort of like banknotes with no repay date attached to them. And in principle, you've now converted all of the government's debt into a form which is just pure money-like. And in fact, Japan has gone quite a long way down that path. Roughly about 50% of the JGBs are now held by the Bank of Japan. Now, the Fed and other central banks, most of them now, can pay interest on reserves. So if you are in a kind of QE world, effectively, the central bank takes on the mantle of paying interest to the private sector, which is typically what we expect the Treasury to do. The Treasury is still getting interest, but it's getting it from the Fed, and that's the Fed is paying interest to the banking system through the reserves. Now, the real lesson from QE, in my view, is that if a central bank is having to do QE because it's hit the zero bound on interest rates, it's a surefire sign that fiscal policy needs to be doing much more, if not taking the lead. One of the problems in the current or conventional macroeconomic policy framework is that by solving one problem, which is done quite well, which is the historical tendency of governments to abuse their privileged access to the printing press, by putting those shackles on the fiscal side of the government, you might say the political side of the government, that has solved one problem. The Fed is not supposed to allow inflation to pick up and stay high for too long a period. Obviously, there's a current debate about that. But by solving one set of problems, another set of problems has been created. Too much reliance on monetary policy, and the economy becoming, in many people's view, including my own, over-financialized, because the financial transmission mechanism becomes so important and so instrumental in macroeconomic policy management. And it's also, when you're independent and separated from the government, as the central bank is, it's difficult to coordinate monetary and fiscal policy, and that can result in a suboptimal policy mix. You kind of get to the combination of fiscal and monetary policy more by kind of chance than explicit coordination. And that's usually regarded as a good thing. I demur a little bit. Fiscal policy has many aspects to it, but it has an important aggregate demand management aspect. So you could pose the question, why is one part of aggregate demand management assigned to a technocratic institution independent of the political realm, that is the central bank, while another part of aggregate demand management is given to, left with, if you like, the politicians? Now, the usual answer is that fiscal policy involves sectoral impacts and has important redistributive implications. That's certainly true, but so does monetary policy, particularly if it travels deep into that quantitative easing kind of territory. Even if those sectoral and redistributive aspects of monetary policy may be less acute and much less obvious, they're still there. So there seems to be an inconsistency in this framework that we have at the moment. Now, governments don't need, I've been arguing that governments don't need to tax in order to finance their spending. That's not really the purpose of taxation, surprisingly enough. But adjusting net taxes can be a very effective and quite direct way of withdrawing or injecting, as the case may be, purchasing power into the economy and thereby modulating aggregate demand. Using tax rates and transfers in that way is kind of the fiscal equivalent, if you like, of the role that the interest rate plays for monetary policy. And I think, and I argue in the book, and I've argued in other pieces I've written, that we need to revisit the design of the macroeconomic policy framework so that we can get a better division of labor between monetary and fiscal policy, and so that we can coordinate them better without, and I think it can be done, losing the independence of the central bank. I don't believe that communication and coordination of the central bank with other parts of the government necessarily implies a loss of operational independence. Now, one of the implications of realizing that the tax lever can, and I think should be used for modulating aggregate demand, and it's not really needed to raise revenue per se, is that taxing the rich, particularly the uber rich, is not the panacea that many people, some politicians, I won't name names, I want to get out of the city alive, may see it as. Now, if the aim is to dampen down aggregate demand, the rich are not a very good target because their marginal propensity to consume is liable to be very low. They're very rich. Take a few tens of millions or billions for the uber rich away from them, and they're still super rich, and they're probably not going to cut back on their spending because you taxed them a little bit, or maybe a lot. If the aim is to fund new programs, it's not the money that the government needs, but the real resources that will be needed to sustain the new programs. And the rich, even if they're taxed heavily, are unlikely to release enough of those resources. Unless the raising of taxes frees up enough resources, monetary policy will need to step in, and by restraining demand, free up the necessary resources that way. Whether it is to restrain the demand or to free up the resources for new program, it seemed to me, when you think this through, there's no real alternative to the burden falling largely on the broadly defined middle class. We don't really want to tax the poor to free up resources because they're very poor to begin with and they won't have much left if you try to do that. The middle class, there's a debate about to what extent the middle class is still there, but the broad swath of people that are in the middle and somewhat comfortable and making ends meet, they have a sufficiently high marginal propensity to consume, and there are enough of them to make a difference. So economically, that makes sense. But politically, this is very tricky, obviously, unless the job were to be given to some kind of independent fiscal agency. Doesn't exist at the moment. But that would be an analog to the independent monetary agency, the central bank. And those two agencies could coordinate. So that's one of the ideas that might emerge from a rethinking of the macroeconomic policy framework, because at the moment, in many circumstances, it doesn't really make sense. We can talk about that more in the Q&A if people are interested. In closing, and getting back to the central bank, there's one kind of circumstance where the central bank turning on the liquidity spigots is really important and a potential game changer. And that is in a financial crisis, particularly a banking crisis. That we have a monetary economy that supports the real economy is an important source of our collective prosperity. But this modern economic architecture entails a lurking danger. It's intrinsic, it's not going away. There is an inherent mismatch between the illiquid nature of the productive assets of the real economy on the one side of the financial system's balance sheet, and the apparent liquidity of the monetary claims that are created on the other side. This is sometimes given the fancy name of a maturity transformation. But just think of it as the assets that the financial system sort of holds or intermediates are bridges and infrastructure and factories and IP and human capital, all kinds of illiquid things. But the financial system creates these very liquid claims like bank deposits and other financial instruments that people can move in and out of very quickly. Now, at the level of an individual, the financial system has no problem accommodating this demand for liquidity. If you went to the bank or your broker and said, I need $1,000, $10,000, give them a few days, if you were lucky enough, $100,000, you could get that liquidity. But if these liquidity demands rise to the societal level, if too many people demand liquidity all at once, such as in a banking crisis, that liquidity is not there. It is only the central bank, via its lender of last resort function, that can instantly, at will, create liquidity that would be demanded en masse in a banking panic situation. Moral hazard concerns notwithstanding, and economists love to talk about moral hazard, looms large, but putting those to one side, we shouldn't be too harsh, I would argue, on the central bank when it is forced to play this role of lender of last resort. It's the only entity in the economy, in the society that can do that, and it is often the only way to save the financial system, the banking system, from collapse, as we saw in 2008. So I'll leave it there. Thank you very much for your kind attention, and I look forward to Arnold's comments very much, and then to the ensuing discussion as well.
Thank you, Paul. We're privileged to have Dr. Arnold Kling here tonight, who is an independent scholar and writes about a wide variety of economic issues on Substack. He's the author of several books. He has been active as a blogger over the years. He began his career as an economist at the Federal Reserve Board, as did I, and subsequently served as a senior economist at Freddie Mac, as did I. In 1994, he started an commercial internet site, one of the first. Arnold earned his PhD for the Massachusetts Institute of Technology. Please welcome Arnold Kling.
Okay, well, thank you very much. I don't like podiums so much. I'm going to talk about the function of banks in the economy, and some of this will overlap with what you've just heard, and if so, then it just reinforces it. But I want to stress these are just my views. There's a vast literature, a lot of which disagrees with my views. So I would describe banks as performing two functions in the economy. One is they provide access to the payment system, and the other is they engage in liability transformation. We just heard a little bit about the liability transformation function. Access to the payment system, and both of those functions intersect or meet at the demand deposit, the checking account that economists call the checking accounts demand deposits. Demand deposits are involved in both the access to the payment system function and the liability transformation function. So access to the payment system, think of you walk into a restaurant or you walk into a grocery store and you want to walk out with food, but you don't want to steal it. So you've got to do something. And as of 1970, what you had to do was bring in cash, currency, or write a check. And that's what in those days, that was synonymous with access to the payment system, was having currency or the ability to write a check. And so economists were quite focused on what they called M1, which was the sum of all currency and deposits that were outstanding, and somehow that was supposedly a kind of causal lever that could be used to cause spending to go up and down, because that was synonymous with access to the payment system. Now that seems a little bit anachronistic now. I don't know about you, but I can't remember the last time I went to a restaurant or a grocery store and wrote a check or took out currency. And I'm even an old fogey. I don't know anything about how to use Apple Pay or Venmo or any of the things that my kids use. And I would say if I look forward to what my grandchildren are adults, for them, the idea that you access the payment system through currency and checking accounts will seem as antiquated as the idea that you access the telecommunication system with twisted copper wire and a landline phone. So I think the traditional monetarist story of money as the lever by which you control spending, actually, I think that story was already pretty weak even back in 1970, is much weaker now and will be weaker still going forward. So I tend to downplay the role of banks in creating access to the payment system. Relatively speaking, I upgrade their role in doing what we call liability transformation. That is, what walks into banks are risky liabilities. Car loans, mortgages, long-term government bonds. So risky long-term liabilities walk in, and what walks out are riskless short-term liabilities. That is, the liabilities of the banks are these demand deposits, these checking accounts, which you can redeem at par at a moment's notice. So the liability transformation function is worth thinking about. And you notice that I myself could not do this. I could not, go up to Bert here, give him a car loan, and then turn around and say, to someone else, okay, backed by this car loan, I'm going to give you a deposit that you can just, you can just cash in any time. I can't do that. So how do banks do that? And I would say there are three mechanisms that enable them to do that. One is they have some expertise. They know they can give a car loan to and who they can't, who's more likely to repay. They also know how to service loans when somebody misses a payment. So they have some expertise that I don't have. Another thing that they have is the value of diversification. They don't just have one car loan, they have a whole portfolio of loans And we know that with a diversified portfolio, the risk falls relative to the risk of any one loan. And they also get to diversify on the deposit side in that, yes, as each individual deposit can be called at par at a moment's notice, in practice, people call their deposits at different points in time, and that creates what it almost turns deposits into long-term liabilities rather than short-term liabilities. So you have that function. And the third way that banks do liability transformation is just plain old hocus pocus. They somehow convince people that they can do it, and they do it. And I think it's this hocus pocus factor that makes the financial sector, and really it's the whole financial sector that's doing liability transformation, not just banks. This whole financial sector quite cyclical in kind of a Minsky cycle sense. So when there's a lot of optimism floating around, you will see, like, the dot-com stocks rise in 1999, or you will see the mortgage loans that don't require any verification of income, assets, or employment, that kind of boom in the 2000s. And then, something bad happens, and then the financial sector is operating out of pessimism, and then there maybe isn't as much liability transformation as there ought to be. So it kind of, I'm saying, and I think Minsky would say that it goes from too little liability transformation to just enough, to too much, back down to too little, that kind of a cycle. Sorry, I'm just checking my time. Okay, so that's sort of the two things that banks do. And so that brings up the role of policy. How does, like, where does the Fed fit in all this? And economists have tended to focus a lot on the Fed as if it were dialing up and dialing down spending through the access to the payment system channel by raising M1 or causing M1 to go up or go down. I've already suggested to you that I'm not impressed with that channel, and I don't really think that that's the main way the Fed affects the economy. I think that the main effect of the Fed is on, and also it's the whole regulatory structure in Washington, on the financial sector is via the regulatory mechanism. And we've had just a long history of regulations. Things like Regulation Q, which has long since disappeared. But the regulatory taxes and subsidies, as I call them, are really what guide the liability transformation process. So a couple of examples. In the early 2000s, the capital requirements were adjusted to, in some sense, reduce the tax to banks for holding highly rated mortgage securities. And that helped fuel the boom in mortgage securitization. So that's a big effect. The too big to fail subsidy I use the term subsidy. That also affects the way financial intermediation is conducted. So the trouble with these using regulatory, what I call taxes and subsidies, is that they're first of all very blunt instruments, and secondly they can't adjust quickly. I mean, the Basel Capital Accords would be adjusted at like 5-year or 10-year intervals. So in terms of fine-tuning the economy, it's not really a great tool to use. Okay, so I think that's a quick sketch of how how I think banks work, and then how policy works. In terms of this book, let me say two things. I think he frames the book around some questions about how, sort of a little bit how the financial sector works, a little bit how fiscal and monetary policy interact. So he frames it with these questions, which is, I think, a good thing. He gives clear and definitive answers, which I think is a bad thing. And that's because I look at the history of macroeconomic thought, and to use a metaphor, I think of it as like an Atlantic storm with waves of conflicting ideas crashing into one another, with unsettled issues floating around. And so I think I think any writing on macroeconomics and money and banking and so on really needs to be conversant with a lot of these views, and needs to not try to sound like, here are the questions, here are the answers, but here are different answers, a variety of different answers. I think I'll be self-serving. I think the best, not the best, the strongest expression of this, Atlantic storm picture of the history of macroeconomic thought is something that I put up on my website that no one has seen. I put it up years ago, but I don't think anyone has seen it. It's called Memoirs of a Would-Be Macroeconomist. And if you want to know that I'm not lying about putting it up there, I think you can find it by doing a Google search for Arnold Kling macro memoir. When I do that search, it comes up. I can't promise it'll come up for everyone, but Arnold Kling macro memoir, and you'll see that I did write something. And I think of everything I've read, that the thing that sort of does the least to convey the uncertainty, the doubts, the on the one hand, on the others, the history of arguments, I think this book actually does the least of anything. I think other books that I've read, that I read, that are treatises on the topic, do allude to some degree or another to conflicting points of view and to unresolved issues. And that's, I would say that and some deeper theoretical differences are what differentiate me. I think a lot of the sort of technical analysis of how bonds work and how the government, in some sense, creates money by issuing bonds. I think on those issues, I think Paul and I would probably be a lot closer than other economists. But on some deeper issues about how fiscal and monetary policy really work, there are probably still some differences. But I'll leave it at that.
Thank you, Arnold. So I guess I'll start out by saying some chapters of your book I really liked, others not so much.
You got to tell me which.
I am. I'm very confused by your discussion of money creation and debt equals government debt equals money. Government, the way I see it, they're not interchangeable. Government, the Federal Reserve can turn government debt into money, should it choose to. But government debt is government debt. If I own government debt, I don't own it to buy things. I own it because I want to save my money and I want to earn a return on it. It's a different. It's not a substitute for purchasing power. So I find that confusing, and going into this, I thought I might get from you sort of a treatise on some views on modern monetary theory, and I think they're intertwined in here, although I'm not sure I'm an expert enough on, I'm sure I'm not an expert enough on monetary theory to pick them all out, but I think you're drawing from that in a lot of ways. So let me just, so maybe it would help a lot if we just said, let's say I want to start a bank, okay? You say I can just create deposits out of thin air. To start a bank, I have to meet all the regulatory requirements. I have to raise capital to start a bank. And if I want to make my first loan, where do I get my reserves to make that first loan? I need reserves in the Federal Reserve System before they can be transferred to another bank if they have to. So if I don't collect those from deposits, does that have to come from my original capital that I invest in the bank? Where does that original reserve come from to make that loan? Maybe I'll start there.
Okay, that's a great question. It sort of goes back to the primitive stage. Can I just say, before I directly answer that, maybe just a couple of contextual, maybe link in a little bit to
I should have given
Arnold's.
you a chance.
No. Let me sort of come to that. So sort of, normally you start a book event with like, why did you write this book? And that kind of, I skipped all of that. I saved you that. But just to perhaps give a little bit of context there, I started life as an academic, more of a microeconomist, industrial organization person. Then I went into financial markets. I spent almost a quarter of a century.
You have a lot of experience. We know that.
No. But in that sort of 23 years or so, you sort of become more of a macro person, and central bank watching, and you write comments and try to explain the world to investors and exchange views, etc. So that led me into thinking a lot about these kind of issues. But when I came back the last 3 or 4 years to write this book, I didn't want to write a treatise, perhaps more like Arnold wanted me to write, which was more of a, all the different views and everything else. I really wanted to write a book that kind of explained how a lot of the things that people in the financial markets are very interested in. How does monetary policy work? How does, do we really need to worry about the debt ceiling and all these sort of issues that move financial markets? Tried to sort of explain them in a sort of a fairly first principles kind of way. And the reason for that was that it was sort of my experience in the financial markets that, and also sort of in academia to a large extent, that oftentimes the descriptions and the understandings that people had were actually didn't map very well into the kind of the reality of balance sheet mechanics and how these things actually work. And you could invoke another Friedman dictum of the billiard table analogy of saying the realism of the assumptions of a model don't matter. All that matters is the predictability of a model. Is it a good predictor? Is it a good model? Whether the assumptions of a model match things in the real world doesn't really matter, but I can't quite swallow that pill. So I wanted to write a book that was explained more also the nuts and bolts of how these things work. And if I just give you a little bit of why was, partly why was that? Well, I mentioned the Bank of Japan's quantitative easing. I'm sitting in Japan, March 19th, 2001, in front of my Bloomberg screen when the Bank of Japan launched what later became known as quantitative easing. And so I spent a lot of time trying to figure out what exactly is this and how different is it from what the central banks normally do, and what is it that the central banks normally do, and how does that actually work? And that has a lot to do with those reserves and whatnot. But in thinking about sort of QE, the thing that really struck me was, to repeat what I said before a little bit, is when the Fed or a central bank does that QE, it's a little bit like a company buying treasury stock. It buys the stock, that stock disappears. It can hold it internally, but it's disappeared. So the treasuries disappear, but what in their place, of course, comes is the central bank reserves. That's central bank money. And that doesn't really have to be repaid. So now you touched on a very interesting point, Paul, which is that you said you don't regard bonds as money or as purchasing power. They're an asset. And I think that is very much the traditional way. So if you look at the way that economists measure money, M0, M1, M2, M3, MZ. Bonds never sort of come into it. Maybe they're out there on some, I don't know, MZ or something, but typically they don't.
The M
But
sort of died.
I do take issue with that because, oh, sorry, go ahead.
The sort of M paradigm sort of went away in the early 1990s. People, the M's weren't very predictive. It's like Arnold's point, credit cards, all kinds of other payment systems, financial innovation. There was no stable demand for money anymore. That wasn't a lever to use, so they moved to interest rates, basically. So monetary policy works off of interest rates now. They don't really pay attention to M's anymore. Go ahead.
Yeah, so sorry. So,
Yeah.
The thing I most agree with in Paul's view is that
There's two Pauls now, so you have to be careful.
okay, that Paul Sheard's view is that government debt looks a lot like money. And one way to think about that now is, how does quantitative easing work? Money money is different from bonds because money doesn't pay interest. But quantitative easing pays interest. It pays interest on reserves, and it pays interest on reverse repos. So that, I don't think you can stand on that distinction between non-interest bearing and interest bearing anymore.
No, you don't know. The world changed. But what the Fed did was it turned 2% government debt into now 5% government debt.
Right.
Because the Fed has to borrow at 5%, and it's only earning 2% on the Treasury bills that it took out of existence.
It's the biggest liability transformation around. And,
Yes,
it came back to bite the taxpayers.
And the Fed is losing $9 billion a month.
Yeah, by doing that.
Which it's borrowing. It's borrowing and paying interest and losing $9 billion a month.
Right.
Well, from the consolidated government point of view, it's the Fed now that's paying the interest rate rather than the Treasury.
But so it doesn't count any longer as Treasury debt, but on a consolidated basis, we still have the same amount of government debt outstanding, and now it pays a higher interest rate than it did.
Well, that's because inflation went to 8% or 9%. But I need to answer, Paul, your question, because I want to come back to your question. Like, what would happen if a bank started to get that ball rolling? So if you started a bank from scratch, so it would raise some equity from somebody. So that would be, they would get a bank deposit from somebody. They'd issue equity. That means they'd raise money. So, I don't know, an investor would then, their bank deposit would transfer to the bank. The bank would now have essentially a bank deposit in somebody else, probably another bank, essentially.
So it would take the money it raised from equity and put it in reserves.
I'm not sure that would be reserves at that point. It would be, obviously you always have to have an asset and liability. So the equities on the liability side, the bank would now presumably have a deposit in another bank. That bank, of course, would have reserves itself. Now, at that point, the bank doesn't have any reserves.
But it could have a Fed account. It could put reserves right in the Fed and earn interest.
So your question was, how does it get the reserves? At the point of, if you like, immaculate conception here, I'm just thinking a very simple balance sheet, the very first day. It's got $10 of equity, and it's got a $10 claim on another bank, essentially a bank account. I think banks can have, Una, you would know better than me, banks can have bank accounts with other banks.
Sure.
So that's what happens. Now, it needs, if it's going to make some loans, it needs, it doesn't have any deposits yet, but if it's going to make some loans, it needs some reserves under reserve requirements. So it can get those reserves two ways. One would be just borrow them from the Fed, because the Fed just can lend reserves. Now, it would have a borrowing from the Fed, and it would have some reserves. Balance sheet would expand. Or it could take its bank deposit and buy a T-bill, for example.
Well, let's come back to the borrowing from the Fed. The lender first resort, primary credit, lender of last resort, secondary credit.
So
the Fed takes collateral.
It can do this. It can
takes
get itself off the
collateral.
ground.
It has to post a Treasury bond or some collateral acceptable to the discount window to borrow the reserves from the Fed.
Well,
I think if you start a bank, you raise cash, you can invest the cash in reserves at the Fed straight away, and you have reserves.
Well,
you have a master account.
The Fed, to get the reserves, the bank, three ways of doing it. One would be to borrow them from the Fed. You said they don't have collateral, so that would be difficult. But in principle, that they could do that. It's not normally done that way. They could buy an asset and then of course repo it to the Fed, or the Fed could buy it. They would then get reserves. Or they could borrow reserves from other banks. Now they'd have a liability, which is an interbank loan, and they'd have some reserves at the Fed. So they will be able to get their hands on the reserves. But perhaps the part that people find more difficult to swallow is the very simple point that the way in which what banks do fundamentally, they need reserves, they need capital, yes, and they need a willing borrower. But once they have those three things, and by the way, very important thing, a regulatory license, a license from the government to operate. Because being a bank and being able to create money by lending, by acquiring risky assets, is a privilege that is very valuable to society and to the bank. And therefore, you and I can't do it unless we get that banking license. But basically what a bank does is just create the loan and create the deposit. And that a lot of people have trouble swallowing that because they think, no, don't they need to get the deposits? No, they need to get the deposits after they've made the loan, because that deposit will probably start to move and they're going to have a hole in the balance sheet. But for the banking system as a whole, it's kind of
I'm not buying it.
I
think you need deposits.
I
think SVB had a problem. They didn't have any deposits.
Paul, I'm really happy now because someone as distinguished as you doesn't agree with my book.
No, as a whole, they create
it.
deposits because of fractional reserve banking. Okay, as a whole, they create deposits, but I think a bank has to attract deposits before it starts a lending business. That's my personal. I don't know of a bank that didn't. I mean, usually they try to attract deposits. Deposits are the cheapest source of funding.
They could do that, but they wouldn't. That's not the way. The point is, let me put it this way: disabuse yourself of the notion that banks lend their deposits out. They don't do that. They need deposits to be the matching side of the balance sheet. Again, let's say that I go to Citi, I get a $20,000 loan, which I did once, and I've now suddenly got $20,000 in my bank account, and Citi's got a $20,000 loan asset, which they claim on me. First thing I did was pay a bit of my down payment on my mortgage. So that $20,000 immediately left Citi's bank balance sheet and went somewhere else. Some of it might come back to Citi. The person that I bought the house from may have taken that money. They may have a Citi account, in which case it just stays in Citi.
I think we're going to disagree on this one. I think SVB grew by attracting very big deposits. That's how it grew, and then it figured out what to invest them in.
It also made very big loans because
they had more government securities and mortgage backs than they did loans.
But what happens, Paul, when
the loans came from venture capitalists? Actually.
Yeah, and there was far fewer of those. They had over 100 billion in MBS and treasuries.
But what will happen is when, let's say that somebody takes $10,000 out of Bank of America and puts it into Citi, then reserves and deposits at Bank of America go down.
I got the whole reserve system thing.
And
but
deposits
if you're
go
a banker and you don't attract deposits before you start lending, I think you're going to run into trouble. That's my opinion. But let's leave it at that. I thought you had a lot of other stuff you didn't touch on in your talk here because you don't have time. But CEO pay, I thought was very interesting. Your views on the euro as not sustainable. I thought a lot of that I thought was very interesting. I don't know. You want to take a minute or two?
Yeah. So there's a kind of sleeper. I wanted to write a book again that was not just on all this stuff we've just talked about, because at the end of the day bores everybody stiff, and we're going to end up disagreeing anyway. But I wanted to write a book on money, many different facets of money. So I have a chapter on financial crises, because the theme of the book is that the slant of the book is to say, look, money does make us prosper. Oftentimes money gets a bad name, greedy capitalists and financial crises and all sorts of things. So I wanted to have a more positive spin, that it's the monetary economy that Arnold was describing as well, that is sort of sustains and facilitates the real economy, and that's what gives us our prosperity. So it's, money's not a bad thing. So one chapter...
We're in favor of money here at AEI.
Great. So I wrote a chapter on inequality, and I kind of stuck my neck out a little bit because who wants to stand up and defend inequality? But I'm kind of in this chapter pointing out that we can't ask a market economy to do too much in a sense. And if you want the innovation and the competition and everything else of the market economy, the market is kind of oblivious and agnostic about inequality. So you'll get a lot of inequality. And in terms of CEO, and I sort of also pointed out, like there is this very simplistic notion of, it's sort of like a cross-sectional view rather than a time series view of, take a rich, super rich person like Mark Zuckerberg or Jeff Bezos, toss those names around, and they're super, super rich. Why don't we tax their money? Kind of argument is out there, but most of their money derives from stock market capitalization. And most of that stock market capitalization is discounting the future prospects for the companies that they founded to continue over years and decades to attract happy customers who willingly part with their money. And some of the wealth that these rich people have actually derives from people who haven't been born yet. It's quite remarkable when you think about the way the stock market functions as a discounting message. So, I kind of, I don't want to come across as some kind of apologist for the rich, but try to explain that there's a version of Adam Smith's, theorem at work with these very rich people, which is they get their wealth typically by virtue of the fact that they're satisfying a lot of people's consumer demands. Now, you mentioned the CEO pay one. This has been a little again, one of my pet theories for a while that I finally got down on paper, which is that it's very, when you look at, I use the example of Jamie Dimon. I think the latest data I had was he's paid something like $35 million per year. And you say, this is just like ridiculous. And yes, I completely get that. But there's a kind of scale mismatch issue here. That if you look at it as an individual, he's an individual, I'm an individual, how come he's getting $35 million? It's kind of preposterous. But if you say, well, what is Jamie Dimon's job here? Well, he's the CEO, and here I'm going to get into some difficult territory because we have the kind of, should firms be maximizing shareholder value or should they be a stakeholder model? But if we stick with the Friedmanite kind of, in a market economy, companies essentially should be trying to maximize revenues and minimize costs and kind of maximize profits. Then you can look at the shareholders as essentially all having a common purpose, which traditionally was maximize shareholder value, get the stock price up. Now, the market cap of JP Morgan, when I wrote the book, was about 385 billion. Now it's more than 400 billion. So if you put yourself in the shoes of the sort of single representative shareholder of JP Morgan who says, I want to hire this CEO, Jamie Dimon in this case, to kind of manage my asset well, I'm going to pay him quite a lot to do that. And I pointed out, if you do the arithmetic, for that representative shareholder who's trying to protect their now $400 billion of market cap, that's the equivalent of paying a cent tip on a $100 meal. In other words, when you go up to the different scale of the economy as a set of companies that are producing these goods and services, you're operating at a very different scale, and that puts that into a different kind of perspective. Now, the euro, cut a long story short.
We're running short of time, and we
questions.
have signs of books. Well, you can talk about that. Let me take a couple of questions from the audience here. Bert first, and then back there, Mark second.
Thank you, Bert Ely. Very interesting discussion. I want to come back to my question, focuses on QE and QT, qualitative easing, qualitative tightening, which to me is just interest rate manipulation. And essentially we have the central bank, a committee of bureaucrats, manipulating interest rates. My question is this: can the central bankers do a better job in terms of the impact on the economy of manipulating interest rates than the marketplace can in terms of relying on market forces to set interest rates? Is it really desirable to have a committee of bureaucrats influencing interest rates and therefore the price of credit?
Yeah, I think thanks, Birdie, is it? Yeah, I think that's I think that's one of those questions that Arnold was frustrated I didn't sort of go into some of the more philosophical sort of underpinnings. You know, there are lots of views out there about, you know, should we even have a Fed? And I think your question is coming at it from, do we really need all this monetary I talked about the macroeconomic policy framework. I was more or less taking it as a given that we need something like monetary policy and something like fiscal policy, but we probably need to connect them in a different way. I don't go far, perhaps, as your question, the premise of your question. In other words, we do have a framework which says there are lots of interest rates, there's long-term interest rates, short-term interest rates, there's lots of financial assets out there that are all connected via arbitrage to the yield curve, and the yield curve via arbitrage all comes back to the overnight rate. And so the central bank, what it does typically is control and set that overnight rate. And then through all these, typically before we had QE, the whole yield curve, all that set of interest rates, was set by the market. So if you kind of like the idea that it's the market that's doing things, not some set of bureaucrats sitting in the boardroom of the Mariner Eccles building, that's good. But of course, they're actually all trying to figure out, all along the yield curve, all the bond traders and all the investors trying to figure out what is the set of short-term interest rates from here to infinity. So even when the market is setting those interest rates, they're setting them essentially trying to figure out what is the Fed going to be doing. So indirectly, the Fed's kind of doing it. On QE and QT, so you're kind of right. What the central banks found was that, okay, you hit the zero bound, what do you do next? If you don't turn to fiscal policy, that if you don't try to juice up aggregate demand using different policy tools, if it's just left with you as a central bank, then you can't cut interest rates much below zero. We used to say you can't have negative interest rates, but that was actually disproved with the ECB and Swiss National Bank and a couple of others, Bank of Japan as well. Still got a negative interest rate, 10 basis points minus on overnight money. So what they said was, okay, normally the short-term interest rate would influence the long-term interest rates through the sort of expectations channel of future monetary policy path. Let's try and do it more directly. Let's use some brute force, go out and buy long-dated treasuries, and in the language that's used, remove the duration from the market, suppress the term premium, and push down interest rates. So yes, you can call it manipulation of interest rates. I don't quite know what the world would look like if we didn't have a central bank and it wasn't at least establishing that anchor rate. We'd have a very different kind of system. I'm not quite sure how that would work. But I think your point, and also some of the questions that have come out, do underscore an interesting thing about monetary policy, which is, I think, many economists, not everybody, but tend to prefer monetary policy because once the central bank sets some parameter, it's left to the market to do everything. So that's very sort of like Hayekian. It's kind of in the sense of it's all decentralized. We're doing minimal interference, if you like, in the economy. But at the other extreme, it's very sort of, you know, something that Hayek would absolutely hate. I like Hayek. I like a lot of economists. But which is, and I think your question gets at this, how can 15 or 17 people sitting in a room collecting data you know, kind of make these decisions that somehow are influencing the whole economy? It has a monetary policy, even though it sort of relies maximally on markets, has a very central planning sort of DNA embedded in it as well. So I'm kind of a little bit ambivalent, at least in the terms of my evolution of my thinking about this.
That was a very short answer to.
Sorry.
You're going to have to sign some books here in a minute. So another question. You had a question back there, Mark? Yeah.
Mark Tenney, Mathematical Finance Company. Insurance regulators are testing negative interest rates for solvency of life insurance companies, mostly between 0 and minus 1%. Do you think that, how much difference do you think there is between a negative interest rate of minus 0.5 or minus 0.75 and quantitative easing in terms of effect?
That's a very kind of, again, very interesting in the weeds kind of question here on monetary policy. As I said, so what central bankers kind of, although they don't talk about this too much, sort of have this implicit idea that a certain $100 billion of quantitative easing will be equivalent to, let's say, 25 basis points monetary easing. So if you could push below 0 to minus 25, I'm just rough numbers here, that would be the equivalent of doing $100 billion of quantitative easing. And you have this question with quantitative easing as well. Should you look at it as a flow effect or as a stock effect? Traders tend to look at it as a flow effect. If they don't see the central bank in there on a day-by-day basis buying treasuries, they don't think it's really having an effect. I think the economic theories suggest it's more through a stock effect. But I don't think that really anybody has a good handle on what the mapping between the quantitative easing and, were you to try to replicate that with negative interest rates. They just try it, see what happens, and keep going. Now, as I said, the Bank of Japan is still doing this yield curve control framework, which at the moment is overnight rate minus 10 basis points and the 10-year JGB yield around about 0, but they allow it to go up to 50 basis points, basically. My own view as a long-term Central Bank of Japan watcher and Fed watcher is once you get to the 0 bound, even though technically you can implement negative interest rates, I just don't think it's worth the trouble. Part of the trouble is explaining it to people. And part of modern monetary policy is based on the idea that central banks should be communicating in a way to the public that the public understands what they're doing. That's what anchors their inflation expectations. Try explaining negative interest rates to the general public, and you're a braver man than me.
Okay, one more quick question here, and then we're signing books. So short, please.
Yes, sorry.
Yeah.
Thank you very much. I'll try to make it quick. SVP, as we all know, is the latest topic du jour with regard to banking. You all both mentioned that one of the part of the magic of the banking system is that you get a banking license that gives you this magic power to create money. However, that license usually has certain requirements. And for example, one is that most banks have terms of service with regard to withdrawal. As you mentioned, if you want $100,000, it may take a couple of days. I keep saying PB, allowed $43 billion to go out in 9 hours, which is incomprehensible to me. And then, furthermore, the banking authorities stepped in and said, with regard to the premises that we had with regard to FDIC limits, et cetera, forget all that. We'll cover everything. So basically, you have a situation where society says, okay, these banks that get these licenses are subject to certain rules that create a certain stability of expectation. But then the first time we have a little shakiness, all the rules go out the window, and we have these astonishing kind of flow of numbers. And I'm wondering what your thought is about that. Is it that these are just one-offs, that you just a fire you put out, or that we're really moving into a new era where a banking privilege is a different thing than we've traditionally thought of it as? Thank you.
Yeah, how do I make this quick? I think the SVB, I do the same thing, it's a kind of strange acronym, is, it begs many more questions than it answers. And I mean, I'm not an expert on it, but I did a little bit of looking into it, but it begs a lot of questions. One of the questions you just raised is, how come they had this massive amount? I mean, this is a Silicon Valley bank. This is like venture capital. Why is so much money just sitting there? Basically as demand deposits. And they were, that was a very, very kind of, they had extreme risk to, a sudden withdrawal if there's any sort of question mark on the asset side. So, gates, why were there not gates, et cetera? What were the regulators doing? There's a lot of regulatory questions. The Barr report kind of has treated some of those, but again, that begs a lot of questions. I find it, and the other thing is, the sequence here, which was, we're led to believe the problem was they had this interest rate mismatch. They're doing maturity transformation, in a sense. Lots of demand deposits, and then, a portfolio of 5-year treasuries, the kind of safe asset. Interest rates went up, inflation shock, interest rates go up. Okay, they may have had some problem, they had to raise some more capital, etc. But I have a lot of trouble buying the story that that was the cause of their downfall, because, for one thing, look at what the Fed did. As you just said, they closed that and Signature Bank down, and the first thing they did was guarantee all deposits. So if they were prepared to guarantee all deposits and invoke that systemic risk exemption, why didn't they sort of do something equivalent to head it off? The other thing they did, of course, was the Fed immediately put in place this bank term funding scheme, which essentially said, even though they're not guaranteeing deposits of the whole banking system, which is something Japan did in 1995 in its banking crisis, which I was not in favor of, by the way. But they said, okay, if any bank that is having a deposit problem, bring your treasuries to us, and we will take them as collateral at par. So basically, essentially, the premium to their market value. So the Fed was prepared to do all of these things in the FDIC and the Treasury immediately after the event. And my question is, if the problem was purely a mismatch between assets and liabilities, but you essentially had safe assets, 5-year treasuries are still a very safe asset, did those banks really need to go under? So I suspect there's a lot more going on there than kind of meets the eye. But that's just pure speculation.
They were actually mark to market insolvent. They had losses. So, but we're going to have to stop there. Thank you very much, Paul.
Thank you.
And Arnold. And we've got some books over here, and Paul, I think, is available to sign. And
Definitely.
And thanks again.
Thank you.